Okay, everyone you're able to see the screen?
Yes, Vivek.
Okay, cool. Thank you. And all right, almost done. Cool. Alrighty. I have my chat on. That's okay. We can talk through it. Okay. So what's happening? Anything new? Anything interesting? Caught your eye?
In terms of stock market,
Anything? Right now we're in
I told you.
warm-up mode, so we can talk about anything.
I told you, right? My dad was coming. Yes, last week, so I couldn't attend the call. So
Yeah.
that's pretty much happening for me. So
Who knows? Spending time with parents is a gift. So I would say, yeah, focus on staying and spending time with your dad. Markets will be there forever.
for sure.
You may not get the same time again.
Yeah, for sure, for sure.
Yeah. Cool. I see a comment. MELI. We will talk about it. We will talk about MELI. That's I mean, as you guys know, I've been in this stock for a few years, and yeah, I was pretty pleased with the results that MELI had came, their quarterly results. Not only MELI, we'll also talk about, other earnings, Shopify. I mean, this week was the busiest week when it comes to earnings, because I think the majority of a big portion of S&P 500 companies, when it talk about market cap, had reported earnings this week. So it was pretty busy week. Obviously, we won't be able to cover all the earnings, but a few in which I was able to deep dive into it, spend time, and then we'll talk about Shopify, we'll talk about Apple, Apple and Amazon. Whether you hold it on your portfolio as an individual stock or not, but these are the two bellwether companies which can move the markets. So we always want to keep an eye on these two big stocks. Apple is what, $3 trillion. Amazon is more than $1 trillion. And of course, MercadoLibre, Block, formerly known as Square, they still have the ticker of SQ, and Uber. So we'll talk about these earnings. I see a comment from Indra saying, how about JEPI versus ACHD? Refresh my memory. I think we had looked at JEPI. I forgot what JEPI had. It was okay. It's a premium income ETF. So here's a. Let me make sure I can bring up JEPI. Right. Let's get year to date. Let's do 1 year only. Right? So JEPI, right? It's a equity premium income ETF, and my assumption is this is basically a ETF which generates income through making covered calls against the S&P 500 holdings. Right now, there is no free lunch, as you would, I always say there is no free lunch in the market. So it gives a huge premium dividend. It's got a good dividend yield. I think it's almost 9-10% or something. Right now it's 6.32, but I think it's closer to somewhere we saw it was like closer to 9%. The reason it is able to give that yield is because of the income that it earns from covered call. Now, the downside of that is you have to give up on your capital appreciation, right? So if S&P 500 is up 18, I don't know, recently, like after Friday, where it is now 17%, you didn't get any of that capital appreciation, right? But of course, you're getting an almost now 6 or 7% yield, which is the income generated by selling covered calls. Right? So now you asked me for a comparison between JEPI versus SEHD. Because I anyway do a lot of covered calls against my stocks, or I do naked calls to reduce delta, me personally, I don't have the need to use JEPI. Now, SCHD is a different basket of stocks, right? So SCHD has got high yield dividend paying stocks. Right? Now, in this year, 2023, most of the money had been flowing onto the growth stocks. And when you talk about these high yield dividend stocks, those are steady stocks like, Home Depot, Johnson and Johnson, Merck, utility companies. Those are not the flavor of the season, right? So those stocks haven't done really much. So if you look at SCHD, it's like down 1.7%. But when in times of little distress or stress, money moves towards more of a stabler stocks, right? Then that time you'll see money rotating into utilities, healthcare, consumer staples. So from my now, given that S&P is at what 17.5% up, I wanted to rotate my money, and that's why I picked up SCHD. And at number 2 is it's optionable. So there are other high yield dividend paying ETFs. NOBL is another one. There are a few more, but looking at the options activity and the volume, I find SCHD is a good ticker if you want to hold it and continuously reduce your cost basis by selling options against it. So that's my 2-minute spiel on SCHD versus JEPI. I hope that helps you, Indra. If not, feel free to unmute and maybe we can talk through it. Question: shall I load up on PLTR again before earnings next week? I don't know what's gonna happen on earnings. So I still hold my PLTR positions. And of course, I think first time we talked about PLTR was in Jan or Feb, when it was like $6, and I did go back and review the thesis and then say, oh, it's too cheap. And I've been adding to my position since then, and also selling covered calls against it, right? So the recent one got called away was at $16. I have no regrets. But I still hold core coffee can portfolio position in my for PLTR. Now, during earnings, anything could happen at the earnings, right? It all depends on what's already priced in. Again, right now, PLTR is being driven by their AIP, a new product, the whole hype around AI, and they came up with their new AI platform. Would want to see again, things that I want to watch in the PLTR earnings is, number 1, the uptake of that AI platform in commercial segment. How many new commercial deals have they signed? Number 2 is what's their revenue growth, right? So these are the 2 things I want to look at in Palantir. There is a lot of news coming out, and it could be because since I became interested in the stocks, so now the YouTube only throws me a lot of news around Palantir, so that might be a little biased, but I did see some new contracts that they are signed. I don't want to take any me personally, I'm not changing any of my positions based on that the earnings is coming up, because what stock could do after earnings is always unpredictable. So, but if your Palantir position is not where you want it to be as a part of your overall portfolio, then you can make a decision. Mine, I think whatever I want to keep in my coffee can portfolio, I have that units and little more, which I'm playing with. So I don't need to add any more right now. So that's on that. CMG was disaster, but MELI said the burrito didn't work. I don't have, sorry, I don't have a CMG position. So I wasn't even tracking what happened to CMG. Oh, it was down 10%. How could Chipotle be down? Because like last week, I probably went Chipotle 3 times for, you know, I'm basically a bowl guy. So I always go and get a bowl than a burrito. But the queues are still longer. So I don't know. Again, I didn't look at earnings, so I don't know what really could have caused this. Ramesh, do you know what's the business? I mean, what happened from a business perspective? I mean, stock could have gone down 10% for any reason, but business side, were they okay or did they goofed up? Yeah. SCHDs, you're fine. Yeah, I mean, I've been using SCHD. Hopefully, you know, if you have used it, you like. My main idea was little dividend income stream through SCHD and also use options to reduce the cost basis. Indra says, yes, I'm loading up on either JEP and SCHD in 401k to counter Blackstone index in 401k. Yeah. Blackstone, is it just the PX or is Blackstone has got any other? Blackstone is, I mean, that's a separate company. I don't know what you mean by Blackstone index. Blackstone largely into properties, and then they do have some REITs, etc. Or I instead by VOO-VTI. VOO-VTI, again, Vanguard ETFs, not an issue at all. But only thing is when it comes to optional doing options on these, there's not much of a market when you're trying to do options on VOO-VIT. So this is like S&P 500. I would rather pick up S&P 500 because if you really look at this, it's like a 50 cents at the money. It's a 50 cents is a bid-ask spread. That's too big. Or rather, if I pick SPY and you go at the money, let's look at 2 cents. So unless, I mean, I rather, my instrument is SPY because the options are very, very liquid. So I don't do VOO or VTI, but I do have some friends who have been doing VOO, VTI, and that's perfectly good instrument if you just want to buy and hold, right? So if you're not even doing any options, then either of these are fine. Only VOO is S&P 500, VTI is the overall stock market. What's your take on whether back load down ticker and move to FANG stock? Sorry, I didn't get the context of that one. Do you mind clarifying the context? Bag load down. So I didn't get it. Maybe I missed that context. Chipotle was overrated. I don't buy and hold, but it's in my waiting list. Glad I did not invest. Okay. I have invested in VO, VTI, no options, long-term hold. Yeah, exactly. That's what. And I have some friends who are just long buy and hold, those who don't have to deal with options. And they've been using VO, VTI because they are cheaper. Their expense ratio is very less. So those are perfectly fine instruments. CMG expected EPS 12.31, actual EPS 12.65. So which is better. Yearly returns fall in line with earnings growth. Sri says, I feel to raise cash at this time, wait for 20 days or so to buy anything. So this is our first meeting after the end of July. So you'll see my portfolio as of end of July. Like every month, end of a month, I come and share in spirit of transparency. So I'll again share. I do have a sizable, right now my cash position is probably the biggest part of my portfolio. And even if, again, not a financial advice, but if I am buying new stuff, those are not SPY. Either it will be the sectors that haven't worked, or doing something on emerging markets or ACHD. But whether we'll wait for 20 days or not, we don't know. What could happen in the market in 20 days, or maybe let's see what happens on Monday. We have seen a lot of time, the buy the dip mentality coming back. A day the market goes down, and then the next day it's back up. So impossible to time the market in the short term. So and I don't even want to try that. Indra say PayPal is down, but I position in it. Should I take loss and move money to buy Meta or AMD? So I don't know in terms of whether I can talk about what I'm going to do on PayPal, because I also have positions on PayPal. It all depends on what's your outlook, what you may already have in Meta, what you may have in AMD. So those decisions become very personal to your own portfolio. But I'm still holding my PayPal positions, because I don't expect it to pay or to recover for, unless they have a new CEO coming in. So I don't know when that news may get dropped. It's a long way for recovery for PayPal, and I am patient. All right, cool. Okay. What else? Anything? Anyone else had any other topic or stock that was? So what was the best stock, the stock that made you happiest in this week? It's a raise cash, but selling long-term put, selling covered calls for Amazon and Google. Yeah, I mean, I have. So at least this week, because, the lot of earnings came out, so the volatility got crushed, and I had a lot of, in Amazon, I had an iron condor. In MELI, I had iron condor. On Google, I had a strangle. So, and those were not even decaying because of the wall staying higher. But this week, after the earnings, the wall, dropped, and I was able to close a lot of those option trades. So still I still have many trades which are for August. And so I'm just trying to close down and wind down the August portfolio, and continue to add to September portfolio. The other one I had was Airbnb. Is Nvidia too high already to jump in? So I talked about Nvidia, right? I have sold. So looking from a valuation perspective, again, my theory was that it's valued too high, but the craziness can continue. So I sold off half of my position. I'm still holding the rest half as a schmuck insurance, because who am I to say that if the valuation high means the stock is going to go down in next month or 2 months or 6 months, or for that matter, even a year, right? The markets can stay insane for a lot more time, right? So I just wanted to, again, because I couldn't make a sense of a valuation. And so I sold off a position, but with keeping the fact in the mind, saying, hey, this AI craziness can continue. Remember .com, the craziness continued for 2 years before the bubble burst, right? So so whether it is too high to already jumped in, I am not jumping in. In fact, I had sold off, and the Nvidia is up, since I sold off. But so what? I mean, I still hold the rest half of my position, and will add to it if it comes down. If not, if it continues to stay high or continue to go higher, yeah, I'll enjoy the gains on the remaining position. I don't want to be too greedy or give into FOMO. I thought when I bought Nvidia and I bought at various price points, right? When I bought at 170, and in a month it jumped to 210, I thought, wow, that's too much. I sold off some. And then I started adding back to my positions at 200, 250 something. Then I sold another tranche at around 300. Okay? Then another tranche at 4. The latest one where I cut my positions into half was around 425, 430-ish, right? But who am I to predict? And then Nvidia went up to 475, and now it's So yeah, 445. So it's impossible to know because a lot of these stocks are right now driven by sentiments, right? It's the same thing with Palantir. So I'm still doing covered call on Palantir. I had some of my Palantir called away at 11, but that was okay because those were like, I bought it at 6 and 7, and then I put a covered call at what, 11. And who knew that the craziness can continue, that the market Palantir will go up 50% in less than a month, right? But that's fine. Against sold a put, bought more, and next covered call was on 16th, and that got called away. So now I have a strangle on 16 and 25. So the stock was, I think, $19. So I put a short put, strangle with a short put at 16 and the covered call at 25. I'm like, 19. So it's already so high. It's at 19. It has to go another 30% high for 25 to get another, a portion of a Palantir got called away. Well, who knows? But it's okay if another tranche of the Palantir shares get called away, because hey, the rest of the portfolio, the remaining shares are increasing, and it falls down, I'll buy it back at 16. The cost basis of that would be around $14 because I got a premium during the covered call when it got called away, and then at a short put another $1.50 as a premium. So that's my strategy. It is impossible to predict what stock gonna do. Yeah, people may want to make predictions looking at, let's say, the charts. From a charts perspective, if you really look at, it's a short one, right? So, this not Palantir. So Palantir has been in overbought for quite some, it was overbought here. It was overbought here. It has been overbought all the way here. And I don't know, what if it stays overbought for such a long time, and if I got an out of a position that was 14, went all the way to 20. So, and I don't have that agility of moving in and out on, day in and day out. So rather I would hold the position and maybe use options to give me some buffer. Same thing, Nvidia too high to already jumped in. Valuation perspective, yes, too high. But does that mean that the stock won't continue to go higher? No. So maybe, who knows, after earnings could jump another 10%. I don't know, but could happen. Or if you also, or these, a lot of growth is already priced in, who knows, it could fall down another 10%. So it's impossible to think or make any predictions on how the stock will behave after earnings. All right, MELI and Amazon made the month. Yep, sold a bunch of 380, 390 put for Nvidia. So those were the bullish trade. What do you think about new quantum computing? IONQ RGTI. IONQ. Is this an ETF? I never looked at IONQ. Again, so overall quantum computing, there are a lot of startups that are coming in quantum computing, but if you really want to be in quantum computing, I think, again, the play will be the bigger, these tech players, or Honeywell could be a bigger player. They are also working a lot on the quantum computing side. Right now, I am not too keen on any of these new startups. Like with what happened this week, with the advent of, let's say, not the let's say advent of superconductor, but the fact that suddenly we started to hear a lot of laboratory labs across the world, started with the South Korean, then Chinese, then Russians, then US, where we are claiming that we've been able to achieve, or at least through modeling simulation, superconductivity at a room temperature. that could just supercharge the whole quantum computing world. But that's gonna be at least a decade or 2 decades out. So for me, quantum computing or any investment on quantum computing is more like a VC investing. Right? It's not where you can get a clear path on, hey, these are the companies that will succeed or not succeed. But if you really, for me, again, the players will be the bigger players, the big tech players who would make use of a quantum computing to reduce their cost of doing the business, right? Or like Googles of the world, who could offer these quantum computing services on their cloud, Googles or the Amazons, rather than, let's say, IONQ or some of the other smaller companies. But these are like VC like investment, and then you should understand the risk when you're doing a VC like investment is you can't invest in two and then wait for maybe one of them will work out, right? So unless you have a bigger portfolio, a size in which you can invest in 50 of such companies, the VC investing thesis is what? Spray and pray, right? You spray a small amount of the dollar values across multiple companies and then pray that one of them will work out. The early investors in Facebook didn't know that the Facebook will become Facebook, right? Now probably they can, they could come and claim that we had that foresight, but really, no. MySpace wasn't doing good, right? So it's more of if you're looking for these smaller players in the quantum computing, and then the strategy that I would follow is what the VCs would follow, which is a spray and pray, or otherwise stick to the bigger companies. And I think we talked about quantum computing in one of our sessions. No, I don't recall which session was it, wherein I looked at which are the different players in quantum computing. Hold on, let me see if I can at least give you the session number. Okay, one sec. So maybe you can go and look at that recording. But this is what quantum computing opportunity. Okay, this is, I guess, oops, 155. Hold on, let me just bring that up. Yeah, but let's see. I hope we actually covered in this one. Quantum computing. Opportunities in quantum computing. Well, I remember I had to go through a lot of YouTube videos to understand who the qubit and what's the philosophy and how that works. But what did you talk about in quantum computing? Investment side. Current stage, it's in a research mode. A long way to go before it becomes reality. Still super early. AWS bracket is Amazon hosted quantum computing. There are a few SPAC mergers. Oh, okay, RGTI. Okay, IONQ. Oh, these names were there. But some of the biggest players are Microsoft, Intel, Google, Amazon, IBM, Toshiba, NEC, Baidu. These are the bigger players. So these are some of the, or if you wanted to maybe go via the ETF route rather than taking a bet on individual companies, right? Or if you want to play the long game, these are the the established companies that you work with. So that's on the quantum computing. Okay. Where the recordings or documents? So documents I don't have, but all recordings are there on my website. It's also there on YouTube. So website, I push all the recordings by end of Sunday, and YouTube it'll go a couple of weeks later. So you can go and view all these recordings on my website. It's free, no charge, but yeah, but you may have to register just to get access to the weekly webinar recordings. These are hoping to bought and acquired. Yeah, I mean, that's the case right now. All the startups, unless you are a AI startup, no funding for you. Only thing is, you better get money either by getting acquired or doing business. All right, let's get going in today's session. Unless there are some other questions, let me look at. Nope. So looks like I answered all of them. Cool. All right. So the biggest, there are, I think, three big news at a macro level that I want to talk about. Not that it matters much, but people do want to, I mean, it keeps you up to date on what's happening in the market. One was US rating was downgraded. That was a nothing burger, I guess. So there are three rating agencies of importance, whatever importance you want to put on in, which is one is not S&P, Standard and Poor's, basically S&P, Standard and Poor's. Other one is Moody's. Third one is Fitch. So, and S&P had downgraded US rating to AA+ in 2011. Now, this week, Fitch also downgraded US long-term credit rating from AAA to AA+. Moody's is the only one who has kept US rating as AAA. So now out of the three, two of them have downgraded. The reasons given were erosion of governance. This shouldn't be a news to us because, hey, the drama that we see during the debt ceiling between the both aisles of the Congress, and then it goes to till the very end. Everyone is on tenterhooks on what's going to happen, what's not going to happen. Will US shut down, or all that, every drama that we see, right? So that's the erosion of our governance, rising government deficits. So what now? Just the interest payment on the US debt is going to be $1 trillion per year. And now the Fitch expect the deficit to rise to 6.3% in 2023 from 3.7% in 2022. In a lot of spending. And the worst thing is that the spending is not going in increasing the GDP in the productivity side, but mostly on the welfare and the social side. General government debt rising, we just talked about it. Medium-term fiscal challenges and all that stuff. Fed interest rate hikes, one more rate hike, which will add more pressure on ratings. So anyway, but the funny thing is, they had, I think somewhere in May, Fitch has told that they're going to review the rating for US. Yeah, that was on May 24th, and warned that it may be downgraded. At that point of a time, there was the debt ceiling. There was a whole discussions going around debt ceiling and all that. But that was then taken care of, at least temporarily. But now they downgraded it. Doesn't make any sense. And looks like market was also of the same opinion. Who cares? I mean, these ratings companies are the same rating companies who had told during 2006, 2007 that all these mortgage-backed securities are AAA rated. Those bonds having subprime loans, they never even, try to look into what those mortgage-based securities were holding, right? So you may want to, put whatever faith, how much of our faith you want to put into these rating agencies, entirely up to you. But market thought it was just a nothing burger, because at the end of a day, still, who else? What's the option, right? TINA, there is no alternative. Who else are you going to go to for buying companies' debt, right? Are you going to go to China? Do you have a faith on the Chinese government to buy their debt? Not really. So even though,
Vivek,
yeah,
my big question is, how can anyone criticize the downgrade? I mean, it's ridiculous. You have these well-known CEOs saying that it was wrong to downgrade it.
Yes. So it's not wrong to downgrade, but I don't think it matters. So I also saw Janet Yellen coming up and saying, oh, it's arbitrarily, it's outdated. That's like saying, hey, if I lose the match, oh, the rules were rigged, right? As long as I keep winning, the game is fair. The moment I lose it, like US lost is whatever AAA, then you say it's arbitrary and it is outdated. I can maybe say a little bit of is outdated because one of the rating factor, and it actually the gentleman who was responsible for sovereign rating of Americas was on a Bloomberg, where he explained and he admitted that some of the factor is outdated, which was, they are probably looking backwards on some of those factors, but they say, this is the process we have at all through, and we're not just going to change because it's US. So a little bit I agree that it is a little outdated, but I'm not saying that it's arbitrary. I mean, if that's this is how Fitch rates every sovereign, and now they're rating US, maybe looking at a data which was applicable as of May, now one of that data may not be applicable anymore. So maybe a little bit outdated, but I don't think it's completely out of whack. So that was a little childish. Janet Yellen coming and talking about, hey, this is arbitrary and it's outdated, because she has to sell treasuries, right? And if you downgrade it, and if the rest of the world agrees that the US credit position, the government of US credit position, or the credibility is in a question, and if they demand higher interest rate for buying the debt, yeah, then it makes sense that Janet Yellen's plan of selling those treasuries become even more difficult. So she has to come in here. But I find it childish. I also heard Jeremy Dimon talking about it, but I mean, he should stay away from this. But overall, in a bigger scheme of things, it's a nothing burger. Right? So right now, I was looking at the overall ratings. So S&P, Moody, Fitch. I don't know what is DBRS. I never heard about them before I got this chart. So these countries have AAA rating from all the three. If we focus on S&P, Moody's, and Fitch. Australia, not the Canada, has AA+. Denmark, Germany, Luxembourg, Netherlands, Switzerland, Norway, Sweden. But how big are these economies? Yeah, European Union, Singapore. Are you going to buy the treasuries or the government debts of these countries? Probably not. So even if we are AAA on S&P and AAA on Fitch, I think from a day-to-day business perspective, really doesn't matter much. And that is why I think market didn't react much to the downgrade. But before you come back to me and say, hey, the market was down and the treasuries the yield was high, it was, but probably not because of the Fitch downgrade. I think temporarily there is a lot of chatter around, and there was I would say, little volatility in the market, but I don't think it's, in a long scheme of things, it matters. Eventually, that debt says it is still backed by the full faith of US government. Now, whatever that means. And right now, if US government and its economy is still the strongest and probably the best capital market, the rest of the countries will still buy US government debt over, let's say, Norway's debt or Sweden's debt. Their capital market itself may not have so much of a depth what US has, right? So just the ratings is not the only factor. So right now, like I said, it's a Tina effect. You downgrade to AA+, that's fine. Where else people will go anyway? There's no alternative. Indra says Fitch is BS. I don't have much experience of the rating agencies. I mean, after this whole 2008 collapse, don't have much faith on these rating agencies anyway. This again, there was an interesting chart, market volatility around 2011. That was the first time when S&P had downgraded US debt, and see still where the market has gone since then. But I do recall distinctly that after S&P had Standard & Poor's had downgraded US Again, there was a lot of political pressure and all that. And I think after a year or two, the S&P CEO resigned. That was the impact. Other than that, if you still look at it, US Treasury bonds, it's not that Treasury bonds started to do well, and S&P market is still, almost 4x since then. So though any impact or the volatility was very short-lived for a year. So long-term really didn't matter. But the bond yields did jump. Right? But that probably, I don't know, was it a reduced US credit worthiness or was it something else? So probably there was something else that caused the 10-year Treasury to hit a new 9-month high. It was just coincidental that the Fitch also downgraded US rating at the same time. Okay. One was our economic strength. The economy continues to show resiliency in the face of Fed rate hikes, right? And as the chances of imminent recessions are fallen, investors are coming to the term that the Fed might keep interest rates higher for longer, right? We have heard this term many times, higher for longer. Number two, I think this was the biggest reason. The Bank of Japan came back into action. And then what Bank of Japan started to do was to buy a lot of government bonds. And that pushed Bank of Japan yields to 9-year high. So that was another reason. Then those who buying debt from US will also command a little higher premium because now they can get a higher from a Bank of Japan. And the third one was little uptick in commodity prices because WTI crude came back to $80 per barrel. And this month, I think energy was the best performing sector. This is why it is so difficult to do month to month, try to build up a portfolio. Because till now, let's say until end of June, energy was one of the worst performing sectors. And now in July month, it was the best sector. Right? Who knows what's going to happen in the next week? Even though I've heard some analysis saying probably energy is going to go much higher, but it's an analysis. So that's why keeping a diversified portfolio always helps. And what else on the macro side? Job report came out. Economy added 187,000 jobs, slightly less than what was expected, but still, I think, still very tight job market. Unemployment rate is to 3.5%. Pretty strong job market. Now the payroll gains are going slower, and the overall 3-month average is, whatever the number is, macro side charts. Balance sheet continues to decline. 2-year T-bill 4.9%. So if you are completely risk averse and you're okay with US government's AA+ rating, here you go. You got a 4.9% for 2 years guaranteed. 30-year mortgage closer to 7%, and that does shows up in the home sales. I think the only sales that are working is the new home sales. Existing home sales have completely dried out. Why would someone sell its home? Why would they sell his or their own home and move into another one and now pay around 7% mortgage, whereas the mortgage that they're currently paying probably is less than 3%. So only home sales that are working, and those are working well, are the new home sales. Right? So if you look at home builders, I think the home builder stocks have done great. And I don't own any of the individuals, neither I own home builder ETF. But if you look at home builder ETF, that's up 37%. The only thing that's working is the new home sales. The existing home, those are owning their homes, they're not moving out. 3% mortgage rate and 7% mortgage rate is a huge, big gap. So that's on the home side. On the mortgage side, yield curve continue to stay inverted, and maybe in the last few weeks we have seen the inversion is now in the opposite direction, means it's trying to close the gap between 10-year and 2-year, maybe specifically because the last week the 10-year jumped up to 9-month high, and that's closing the gap between 10-year and 2-year. But again, market is still the yield curve. If there is any indicator of a recession, the best indicator so far over the last 50-60 years have been yield curve. But the other thing is, if you're already expecting recession, then probably you may not get recession. And now the economists are all pricing in and talking about that we may not even get a recession, right? Goldman Sachs have reduced the probability of recession to what, 20%? And a lot of these Fed economists are now saying maybe we will have a soft landing, right? Or maybe no landing. We'll just probably come out of it unscathed. But we always, the other side is, we always think that this time it is different. But I think history may not repeat, but would rhyme. And then it generally takes 12 to 18 months for the Fed rate hikes to actually show up in economy. So is it too early to say right now that recession won't happen? No. And I don't think anyone can say it for certain. So it's a 50-50 guess, or maybe 40-60, or Goldman says 80-20. But yeah, so I'm not making any drastic changes, thinking that recession will be coming or recession may not be coming. As long as your portfolio is constructed in a way that you don't need money for next 2 years, who cares if there is a recession? I mean, we have seen many recessions and the market over long term still continue to go higher. But just make sure that if a recession comes in and the market dips, you are not forced to sell out of a securities because, hey, I now need to pay my bills or I need money for wedding next year, and which I put in the stock market, or I had my college kid, the kids' college expenses in the stock market or whatever, or I wanted to buy a home and I put money in stock market as a down payment, and now I want to protect it, market going down, I'll be forced to sell to withdraw the cash. As long as you don't have those needs, who cares the recession is coming or not? I mean, especially I'm only focused from an investing perspective, right? There are other repercussions of recessions, which is obviously not good for, may not be good for, the personal lives of individuals. But from an investing perspective, we have seen many rounds of recession earlier. So should still be okay. S&P, I see another chart Simon shared. This is what our federal total debt as a percent of the GDP. Yeah, so now we are 118%, which is, I mean, we will always run as a deficit because us being a a global currency, we will always have a deficit economy, and we will always have to continuously raise debt. Right? Now, is 118% too much, or is 140% too much? I think Japan is way higher than ours. Right? So, or maybe because it's the first time after a very long time. If I was reading somewhere, and I think in maybe 1960s or somewhere, we had 140%. I could be wrong on some numbers, but this may, because now it has come after such a long time that people are now shocked, saying, gosh, we have more than 100% of our GDP as a debt, but you were Japan, that's a way of life. Right? So if this state continues for longer, I think the companies will adjust to it. That's all. But yeah, after a long time, but now we have a more debt than the GDP. S&P PE ratio close to 25, which means 4% yield. More appropriate is a Schiller PE ratio, still very elevated, 30.89, which is, I think, over the last, from 1880s, it's only been a few times when it has been above 30s. Right? So that does tell that S&P is very expensive. It is still expensive, right? But that does not mean that the stock is going to go down tomorrow, right? So, and I also saw some Memesters are coming back in the market. Look at the Tupperware stock. Anyone holds Tupperware? Tupperware stock probably will have this Tupperware products in the kitchen, but Tupperware stock, they declared bankruptcy. It was 60 cents. And then now it's what, $4. I don't know what's the latest one. The chart is maybe a day or two old. But I think the best way for CEOs to raise the stock price is to go and declare bankruptcy. There's still a lot of Reddit crowd who are latching on to these. I would say these are your arbitrage plays, may pay out if you can exactly time it, or be ready to lose everything that you put in. So now since the stock has been pushed up from 60 cents to, let's say, where is top? 4.77, right? Which is almost what, 8 times 800%. So stock is up 700% from in what, 3 weeks? Not even 3 weeks, just maybe around 10 and 15. Yeah, just 2 weeks. The best thing that the CEO can do is to go and issue some stock. Right? Issue some stock, get some money, get out of a bankruptcy, pay down your debts and get out of a bankruptcy. If that works, that's great. And as a CEO, I would say it's perfectly right thing to do. AMC CEO had done it multiple times, right? When the AMC was driven by the Robinhood and the Reddit crowd and during the whole meme mania during 2021. So AMC, I think multiple times they issued the stock, dumped it onto those retail investors who wanted to do this arbitrage or do this lottery tickets, and AMC has still survived. Stock hasn't survived, but as a company, he was able to prolong the agony, or I would say prolong the life of a company. And the best thing that I guess the Tupperware CEO should do is to take advantage of this market craziness and get that cash for restructuring. So I don't know if this is going to be the playbook for every, it could be playbook for every other company which is in distress, right? Go and announce, if you're holding an iconic brand, go and announce that you're going bankrupt. There are a lot of people who are there to come back and, push up your stock price. So I don't know. I mean, so some things like these just tell me that, hey, is a froth back in the market? Are we going to see the same kind of a frothiness that we saw during 2021? Who knows? So anywhere followed Tupperware? I only heard about this saying, hey, the Tupperware stock after declaring bankruptcy has gone so high. I'm like, what the heck is happening here? All right. What else? Any other such meme stocks? I mean, I don't track, but sometimes it is fun. It's a sugar rush. If you want to have that, I don't have this sugar rush. AMC short put 3 to 4.5 paid off good so far. What's the premium? I've never traded on AMC, but I guess probably the premium is, wow. It's 25, more than 25% premium for at the money short put. So, and the IV is like 200%. Yeah. So this is a these gambling stocks, and I guess during January 2021, some of these IVs in AMCs and the game stock was close to 300% and 400%. So the huge amount of a premium that was available. But again, as I would say, the premium is a icing on the cake, and the cake is a AMC stock. And if you're new to options, and so I would caution you, as I had cautioned during 2021, well, some of my friends, they sold short put because the premium was so high. They said, oh, come on, it's like we're getting 30% as a premium, right? And then they eventually ended up, they got assigned on the stock, and then the stock fell down after the mania was done, and the positions are underwater. So yeah, if you are selling premium on this one, this premium is icing. Make sure you like the AMC cake, right? That you may end up holding the cake, right? you only like the icing, but you may end up holding the cake, and that's fine if a position is small. What is a $4 stock, right? At the max, it can go down to zero. It won't go below zero, so the risk is very limited. So at this point, yeah. But trying to do that same in a GME when the GME is $300, huge risky proposition. Some of the other meme stocks were, sorry, not GMC, GME. What's happening to GME? $20. Vol has gone down in GME so much. No one trading GME. What happened to the whole Reddit crowd? No one interested in GME anymore. Now the volumes are so low. Even the out of the money calls are like what, 3,000? That's it. Max is 8,000. 30 strike call. Premium is, I mean, still decent. I mean, this is what, 1.5, almost 7% premium. But yeah, IV is 83%, which when it talks about GameStop, 83% is nothing. All right, enough of meme stuff. So looking at a fear and greed index, we have moved from extreme greed to still greed. So again, little word of a caution is don't get into FOMO. Markets are, I mean, we looked at the S&P number, right? It's still expensive, but who knows how long it's going to continue. So that brings me to the next topic is 100% downside protection ETF. Right. So now if you're thinking, where's the S&P? SPY is up, what, 17.5% for the year. Let's say 17.5% for the year. And if you think, guys, that, okay, I think I made enough now. I have some expenses that are coming out. I need, let's say, next 2 years, I want to put a down payment for my house or whatever. I want to have some lavish wedding, and I need money for it in the next 2 years. Let's say by June of 2025. Right? Now, you just heard me saying, hey, make sure you don't have it in the market, and say, oh, Vivek told that I shouldn't have anything in the market which I need for next 2 years, because the markets could go anywhere in the next 2 years. Right? And if we are just buy and hold, again, that's how I work. But if you also deal in options, there's a way you could have 100% protection. Zero means 0% downside. So if you invest $50,000 at the end of a 2 year, June 2025 or July 2025, you'll get back $50,000. Is it possible? Is this for real? Or how do we actually do this stuff? Right? Rather than maybe getting out of a market, how do we do this using options? So the reason why I want to talk about this is I was listening to a podcast in which one of ETF issuer talked about similar protection ETF. Then I thought maybe I'll give you both perspective, how you can do it yourself, fish yourself, right? Learn about it and you go and fish. Yeah, Asif, you're going to the right, you're going, you're heading in the right direction. Right? There is always a catch. There is always a trade-off. So we'll talk about it. Either you fish yourself, which is what probably I'll show you how you can do it, or there is a fish available in the market, then you have to pay a price to go and buy it from the market. Both the options are available. Right? But given the fact that the markets are already up 17.5%, a lot of people might be having this thought. A lot of retail investors might be thinking, gosh, is it going to go high? Or maybe shall I protect my gains? Shall I sell now and move my money into safer treasuries or cash or CDs, because I need that money in next 2 years. I don't need it right now, but it's starting 2 years from now, I will need this money. So I don't want to take any risk on this. In between, if it goes on, fine, but at the end of a 2 year, I need to make sure I have 100% downside protection available. Jay says, this reminds me of index universal life pitches with capped upsides. Yes, it does. So we talked about those IULs also, right? So we saw a lot of those coming in 2022. And again, but this one is not from an insurance company, but on those IULs with the capped, and I even forgot, I think I brought up a few of them out here. The upside cap was very less, right? So I took today morning, I just built up that scenario to see how much upside gain you can get. So you get a S&P 500 exposure, you have 100% downside buffer, right? And then you have a upside, 1:1 upside on S&P up to a cap, right? And we are looking for maybe 2 year or 1 year outcome period. So I'm assuming, let's say if you have 89,000, and the reason I picked up 89,000 is because, it makes the math easy. Given that S&P 500 is close to 445, it makes math easy for me. Otherwise, my brain hurts. So I said, let's assume you have $89,000 that you have available in your portfolio, and you don't need it right now. But you want to make sure that 2 years later, when your house down payment is coming up, you at least have this minimum $89,000 available with you. So that's a scenario that we're going to walk through. Fair enough? Anything else? So if you have 89,000, you can buy S&P 500, 200 units of S&P 500, right? Assuming S&P 500 is close to 445 per share. That makes it 89,000. Now, along with that, then you basically do and this is what's called as a collar, right? Collar, add a collar option rate to it, which means you buy the put, because there are 200 units, you buy 2 contracts of S&P 500. So right now, I think, so the one which I have, this is for 1 year. So you buy S&P 500, 2 contracts expiring 28th June 24, which is closest to 1 year, right? At 445. So you bought S&P 500 at 445. You bought a put at 445. And then you're also selling a call against the same at 472. So now when you sell a call at 472, that caps your upside gains, right? So if S&P continues to go higher, you have a 1:1 upside. If it becomes 446, your portfolio is up $200. it becomes 455, means $10 per S&P. Your portfolio is up 2,000. Your portfolio will track 1:1 with S&P till 472. So 472 is what? Almost 6% upside for next 1 year. So now if you're thinking, I already got 18% this year, and now need to protect it for next 1 year, I can get 6% upside for the next 1 year and don't have to pay much. In fact, in this case, you're actually getting paid 12 cents per contract, right? So ignore that. You don't have to pay anything for this protection. And given 28th June 2024, if the S&P is below 445, you will make use of your report and you will be able to sell it at 445. Plus, you get maybe on an average, long-term average of S&P 500 is around, dividend yield is around 1.9 or something. Let's assume simplicity's sake, it's 2%. So you still can craft, using this option, your portfolio to yield you another 8% on the upside while having 0% downside risk. Make sense? So let's plot it. I think I already had plotted it in a graph. There we go. So this is where you buy your S&P 500. For simplicity's sake, I assume 445. I know it's right now it's 446, but then I'll also use the put at 445. So you bought S&P at 445, you bought 200 units. This is how your P&L will look like. Okay. Market goes higher, your portfolio goes higher. Market goes lower, your portfolio goes lower. Track 1:1. Now you add on to this collar trade. Now, if the market goes lower, this red line represents what your portfolio will look like at the end of this period. Right? Now, don't come back and say, let's say during December, the market is down 10%, and you're saying, oh, where's my protection? My portfolio is lower than 89,000. Hold on. Short term, you may see that you may not have 100% protection because of the time value remaining in the put option. But come 28th June 2024, this red line is what's going to be your portfolio position. If the market is at 410, right, you still didn't lose anything. If market is at 490, you don't gain anything beyond 472, which means beyond this line, your upside is capped out here. But if that works for you, right? If this is a scenario, if this is very tactical, time-based, portfolio construction to protect the gains that you have had. And if you're feeling a little jittery about protecting your portfolio because you have some expense that is coming out in next 1 year, and you don't mind capping your upside beyond, let's say 6 + 2, 8%, given the fact that you have a guarantee that you will get at least what you have invested back to you. Now, if the market doesn't do anything, that's fine. You just make $24, right? I mean, your portfolio is still the same. The market goes up, you will participate in that growth, right? Let's say market closes at 470 in next 1 year. Right? It could have gone to 420, 410, come back and closes near 470 when you need the money. Right? You still own 200 shares. Sell those 200 shares at 470. You enjoyed some upside gain. You made like $5,000 right? On top of what you may have already made so far, right? So again, if you're using options, then you could still stay in the market even if you need money for the next 1 year, But then you should know how to protect your portfolio by putting a collar around your portfolio. But if you're not doing this, then anything can happen in next 1 year, 2 year, right? Then look towards the safer havens. Asif, is it a fixed duration? Sell after 2 or 5 years? I mean, you can pick up your duration, right? So this is entirely up to you. So let's now look at another scenario, right? Let's say if I move it out to 1 more year, let me see. Let's say June 20th expiration of 470 is not even traded. Let's say June, if I go to June 25th. June 25th. Okay, so yeah, we don't have 470 right now, but let's say I'm buying a 445 because that's where I bought a put option. So I have a 0 downside risk, 100% downside protection. And then, but if I do this, I have to pay $34, right? Which is almost 9% of the current one means, but I don't want to pay that. So let's sell this 490. Okay, so even let's sell 495. Yeah, I think this is the closest to 0 that we can get. Right. So this, okay, and let me analyze this one. Now in this one, if you, let's say you want to protect for the next 2 years, right, and you want to take the decision right now, you can enjoy upside up to 495, right, without any cost. In fact, you're getting paid $100 for doing this trade. Okay. But if you think, oh, maybe, who knows, like this year, S&P is up 17%. Maybe in next 2 years, maybe next year it could be down, but it could gain back in 2025. And I don't want to cap up my upside. That's the decision you have to make. But if we are okay with getting another, this 445 to 495, 50 means another 11% upside for the next 2 years, plus add another 4% of a dividend yield, 2% plus 2%. So almost 15% gain for the next 2 years. You could go out for 2 years. So that's a decision you have to make. So I took up the 1 year to see, it's 6% upside plus you get a dividend yield. But you can look at your duration, whatever the need is, right? Or maybe do 1 year, then take a decision again on 1 year. Entirely up to you. But that means little more work. But this is, I just wanted to basically share how you can construct this, right? If you deal in options, and can always reach out to me from a questions perspective, but this is the right way of dealing in options and not trying to make a gambling bets by buying just out of the call, right? Use options to reduce risk in a portfolio. Use options to make sure you have the money available when you really, really need it. So this is one way you can construct your portfolio, have a 0 downside risk, and still enjoy upside to some limited amount, which you would be okay to do it because the reason that you need money for is way more important than getting some more upside in your portfolio. Say you have some hospital surgery coming up. I pray it's not, but that's way more important to get the surgery done and whatever pay out of a pocket than trying to see, oh gosh, can I make another 5% on this and raise that portfolio? No. So depending on the reason, if you have your kids' education coming up, would you want to sacrifice that for another a few gains in portfolio? Probably not. Okay. Jay says, wait, isn't the dividend yield taken out of SPY price, so it cancels out? No, so right now, if I'm looking at 6%, right, then it's not right. So eventually, when the dividend will be paid, S&P will come down. But let's say even that, again, I'm not gone into the details of this, but it could be 1% here or there. Bob would say, what happens if it goes down 20% after 1 year? So that's a great question. So let's say after 1 year. Oops. Where we were, was it 28th June, right? After 1 year, so on 28th June, you have this protection available. Let's say market was at 460 or 470 at 28th June, and you were happy, you didn't sell it, and your protection expires after 28th June. And let's say on the 1st of August, because Friday, 29th, 30th, Friday, Saturday, and on 1st of August, market falls down by 10%. Sorry, you didn't have any protection. You get exposed. So this protection expires after 28th June. What you could do is maybe on 28th June, put another protection. Let's say the stock is at 270. Do similar trade at 270 by buying 270 put and then going and trying to put a collar for the next 1 year. Again, these are the things that you can do. I see a hand risen. Yeah, go ahead, Anirudh. Ask her question.
I'm going to ask a very rookie question. So oftentimes, like when you purchase options and keep them, like just say long term, by the day goes by, they do get reduced in really high value. Like usually they say that the Greek values go down.
Yeah,
and the
theta goes down. Yeah.
So then how will this will help me if I, let's say, hold it for 1 year?
Yeah.
Wouldn't that go down in time?
Yeah,
And
so that is,
so
you're absolutely right. One thing is, it's not a rookie question. I think it's a very intelligent question. Most of the rookies don't even ask the question and they just buy the options. So that is why I mostly sell the options. I don't believe in buying the options because you're playing against time. And one thing in the world that is certain is time will always move forward. Now, the reason is the fact that that's why I just didn't buy the option, right? I also sold the option against it. So when you sell the options, you are benefiting from the theta decay. So that is why eventually I don't have to pay anything. So in this case, in fact, I'm being paid 50 cents. So nothing is going out of my pocket. So of course, the option or whatever 445 that you bought continuously go down in value if the stock doesn't go below 445. But so is the value for this one, which you have sold. So the net, that's why it basically nets out the impact. So I'm sponsoring this 445, the buying of this by selling this call option against it. And this is technically, this is called it's not a collar trade, because in a collar trade, you will basically go and do a equivalent normal equal delta or sometimes equidistant. But in the same collar trade, you buy a put and you sell a call. In this case, I'm buying a put, selling a call in a way to achieve 100% downside protection and without any upfront investment. It is like buying an insurance without paying any premium and sacrificing some of the upside beyond, let's say, 490. I don't get to enjoy the fruits beyond 490. But if that works for you, or in this case, this is 472 for next year. And in this case, if that works for you, from your investment requirement, this works for you because you want to protect your current portfolio, then there is a way to do it. That's all I wanted to share.
Got it. And so when you mentioned that you also get dividend yields, but like my question is, when you hold options, does we usually get dividends? Because it's only for stocks, right?
You're getting dividend yield because you're holding these 200 shares. So I will gonna talk about something else also. So you're holding 200 shares, that's why you're getting a dividend income. So let's let's go back. You have $89,000, right? Which you want to protect. You buy 200 units. And now you could reverse it. Maybe you're already holding SPY in your portfolio. And you can substitute SPY with any other ticker, right? Since this is the most traded ticker, very liquid, I picked up this, right? So in your trading account, you already hold SPY, you have 100 SPY. You can do this only for that portion, right? You may not have to do for entire portfolio. You can determine what's the amount that you really, really want to protect for sure, and then construct your portfolio based on that. I know it's maybe sound too good to be true, but there's a catch is that you don't get to enjoy the, let's say next year, S&P goes up another 15%. Then don't come back and say, oh, my upside is capped at 6%. What the heck you did? Hey, that's a decision you made. No one can tell what S&P is going to do next year. But what if it goes down by 15%? You'll be the happiest person on the earth that you had this, right? But what S&P going to do? I don't know. But if you have a need to protect it, there is a way, rather than getting out of the market completely. Because if you get out of the market completely and move into cash, you get whatever 4%, and then the capital gains basically, and the tax treatment is also not efficient.
Vivek?
Yeah.
I just added a trade to it. Can you see if you can paste this in? Adding a vertical call spread actually makes it profitable all across the board. It seems unbelievable. So to exactly what you have, if you add the one I pasted, paste that into TOS and analyze it.
Where did the paste go?
The white paste button.
Where
It's
did,
left of the
there
screen.
we go.
There you go. Can analyze that. So that caps the upside on the very high. So no, leave your red. Leave your red.
You're adding.
Yeah, so I'm capping the extreme upsides, but look, it's profitable all across the board. There's no loss anywhere, and it's even if it goes down, now you have $1,000 profit.
Yeah, so you basically added another call spread on top of it.
This is a bearish call spread to cap. Yeah. If it goes extremely high, I'm saying I'm happy. I'm happy with that. But look, that also increases the downside amounts. A graph.
Yeah, because you got additional premium. Yes.
Because you got. So there's got to be a catch in this. Is it a dividend? Something. There's a catch we don't see here because everyone would be doing this, right? All the funds would be doing this guaranteed upside, no downside style trade. So it's just a simple, on the same date you had, I added a call spread to collect some more premium.
Allow to figure out to see what the catch may be. What if there could be a catch on early assignment? Because now you're having one negative short call. In that case, then we may have to figure out. Let's say S&P. No, but you have a 200 shares, so it's not naked. There will be some catch. Again, we'll have to figure out what that is.
Yeah, I'm liking the graph, but
yeah. I mean, it looks amazing on the graph. But similarly, remember our discussion on Nikola trade? Had a zero loss trade.
Yeah,
then people ended up losing their portfolio. And I'm like, dude, why do you go so big? There may be some catch. You just have to figure out.
I guess the catch is the T0 line can go negative in the meantime, right? If it goes up,
yeah. So meantime it will go negative, and then your broker may liquidate your portfolio if you don't have a big position size, right? Because you may not be able to hold this trade until expiration. That may be one catch, that if S&P just blows through. But it's a spread, and that's why I'm amazing that if it's a spread, why it could be. But that could be one catch in terms of will you be able to hold this trade till expiration?
Vivek,
yeah,
change the profit and loss open to delta you will get a different picture altogether.
Say it again where
Oh, on
the
top,
top,
yeah, on top where the metric is P&L open, you can change the metric to delta. All the way on top, above the
higher.
graph.
Yeah,
above the graph. P&L open to
delta.
delta.
So this is what happens. You will have the shares as long as your position is not called away.
Yeah, so
There
there
will be lost 200 shares. You'll be short 200 shares if it goes to 500 to 520.
yeah, you may not, but while will be yeah,
That's only on
because I have a
expiration
two,
date.
no, because I
Meantime,
have a two short calls, right? Yeah, so you become short, and if you're not able to hold this position, then the broker will close your trade before expiration. Yeah.
And you have two different time periods also.
No, it's
no,
both.
it's the same.
No,
It's all the same
time.
date.
It's 28th June. So let's say, again, we are getting
June
to the
25 and June 24.
No,
That's
You
not
have
checked. That's
that's
gone.
not checked. It's only 24.
Oh, okay.
Yeah.
All right.
So let's assume hypothetical scenario. And sorry, we are getting a little more details. And this is what, it's a great discussion. So thanks for bringing this up. Let's say we do this trade, which seemingly looks like we can't lose money on it. And say after 3, 6, 7 months, S&P is at 510, 512. Okay. You're negative 200 deltas. Now, if you can hold this position, then it's fine. You will eventually hold this position for till 28th June. You will eventually ended up making money. But if your account size is not big enough to hold this negative 200 deltas, short position, and a brokerage may want to, you may end up in a situation where a brokerage will say, oh, no, you need to close your position right now. And that's where, you may get into a situation in which you will have to sell some shares or do some stuff which may not be favorable to you. So that's, you're right. Yeah, that's where the risk will be. I just missed out. We had one short call here as well, right? So we are having two short calls. And if you're not able to hold that position, that's where the risk will be. But it's a good trade as long as you have a big enough size of portfolio to hold negative 200 shares, and your broker won't liquidate it.
I posted the P&L every 60 days. If you click that graph, that shows the P&L every 60 days. So in the beginning, you could be in the hole for a while.
Like here. Yeah.
And then you slowly get back out of it every 2 months.
So one thing which although this is at expiration. No.
Yes.
In between at expiration, that's where you have to now start looking at,
Day step
and see how the situation may move.
Yeah,
so,
I put 60 days, so every 60 days.
Cool.
With increased volatility, your pricing of the options will change.
Yeah. So in between, things could change. But if your portfolio is big enough to hold through those changes and vagaries, and max is negative 200 delta, and your portfolio is big enough that your brokerage won't liquidate, then makes sense. Right? Because at expiration, this will still hold true. In between, things could happen. And if you're not able to hold this position, same thing's happening with the banks, right? HTM. So yesterday I was talking to someone, he told, you're saying treasuries are safe. Didn't the bank failures was caused because of treasuries? I said, not because of treasuries, because they were not able to hold it till maturity. They marked all the treasuries at HTM that if you hold it till maturity, you'll still get paid. But in between, something happened and they were not able to hold till maturity. And that's where a lot of these bank failures started to happen. Similar is the case here. If you hold it till expiration, this P&L graph shows what will happen. But in between, things could happen. And if you're not able to hold till maturity, that's where we end up into these issues. But one more thing, I'm not done with this yet. how you can enhance your returns even more than this. So instead of, let's say, buying 200 SPY units, right? Maybe we do what's generally called as a poor man's or stock substitution trade, right? Again, using options.
Yeah.
So instead of me trying to buy 200 units of SPY, I'll go and buy the deepest in the money option available with me, right? This is 98 delta, which means it's almost replicate 1:1. 1:0.98 with the stock movement. So now instead of me putting $89,000, right, I would rather just have this in which I'm putting only $60,000, and I'll replace this with this. And let's take off this. I'm going to put only $60,000 and craft this trade. It shows me negative.
Now you have two dates. Is that what you want? You have two expirations, 25 and 24.
Oh, it's 25. Oh, gosh, 24. I'm like, what's this? This is my 24. Oh, this is not traded.
Unlock the price. Yeah.
No, it looks like this 150 is not even there. So let me go back and see. Well, you get the idea. Saying instead of maybe buying a share, I buy deep in the money, which is better capital allocation. But the catch is you don't get dividends. If you
The other catch is, the real catch is that IVs can change differently between. So if you have two dates, now you're going the same date. But if you have two dates, the IVs could shift between them, which could create a downside.
Oh, yeah, I didn't want to do that. 2 different days. I just want to keep it the same day for your stock substitution, as well as for, this is 28th June. Oh gosh. I again picked 28th June. Oh, this is 21st June I picked up. So 28th June. Oh, the latest one I have is 315, which is, let's say, 90%. So you can capture up to 90% of, instead of doing 1:1 upside, you have a 90% or 1:1, 90% upside gain, but then add a 28th June, 28th June. Why is this? Okay, let me delete some of the others. Okay. Yeah, so now in this case, you only invest 148. Let's end. So basically just $30,000 instead of investing $89,000.
But the downside is bigger.
Yeah, but you still, but you're still holding out of 89,000. You have a 59,000 still available. So the downside is what, 3,500. You still ended up saving a lot of money. So again, let's not, if you really don't want to complicate, easier one is this. So if you're a beginner one, this is how you could do it. Or you could buy a fish. This was, hey, how you can fish yourself. Or if you buy a fish, again, this is what the whole reason why I went into this, because I heard about this ETF in a podcast. Again, that's not a recommendation. But if you don't want to do this, there is an ETF available, but they have a 2-year cap. They don't do it for 1 year. It's a 2-year cap, but the cap is 16.6% for next 2 years. This is Innovator Equity Defined Protection ETF. So it looks like this is the first time I even heard about this issuer called Innovator. Is an ETF issuer, and they have a lot of ETFs. So while I was doing study for this one, I realized there are a lot more ETFs, but the concept is the same. They basically will buy the other one, they'll buy deep in the money option, which will replicate the stock, and then they'll buy a put at the money put, and then they'll sell a call to sponsor that at the money put, and you don't get dividends, and the maximum upside for the 2 years is going to be 16.6%. Right. So they did a comparison of, hey, if you buy this, if you have a 2-year treasury, you're going to make 9.5, CD, you're going to make 9.7, and this one, you're going to make 16.6. But include this expense ratio of 0.8, so almost 1.6 expense ratio. So you ended up making 15% is your max what you can make with 0% downside for 2 years. And this is a holding for that ETF would be deep in the money, SPY at a strike of 8. So I think they probably, I mean, I don't see a strike of 8 on, and they are probably doing on SPX or XSP. That is why it is more tax favorable, but the concept is the same. Deep in the money leap, stock substitution, at the money long put, financed by selling a call at the higher price point. What you don't get is a dividend. In this particular case, upside is capped at 16%. It is tax efficient because they are using index options, so which is section 1256 contract 60/40. You get taxed on 60/40. So if you're interested in exploring this, not a recommendation, and I don't get paid. They don't even know who I am, but I happen to be on the podcast. I thought maybe I'll give you the basics how these things work. Either you can do it yourself, or you can do this. Or if you want to listen to the podcast, here's a link. All right, let's do your own study. The only thing I can get is maybe generate some interest in you, generate some spark in you so that you can go and then do your own study. But there is a way to construct using options 100% downside protection, but with limited upside. There is no free lunch. Now, before I end this, I want to say why you should learn to fish. And that's my intent to come and talk here is we want to learn how to fish ourselves. Is an interesting graph I saw is with the fee, right? So 100,000 pounds invested in MSCI World Index over 2 decades, starting from 2002. If you have 0.3 fee, you ended up that 100,000 become, let's say, 275K. If you have 1.3 fee, that is down to 20. It's a 50K difference, right? Which means your 100K investment earlier is almost 50% of your initial investment just going into paying the fee. So if you can fish yourself, better it would be. But if you can't, making 225K from 100K is not bad, right? It's better than putting in a CD. It's not bad, but if you know how to do it, it'll be way better. Cool. All right, so that's around 100% downside protection. It is for real, but you need to understand the trade-offs around that. And if you are okay with the trade-offs, it works for you. Then you don't have to care about what others say that, hey, I made 20% in 2024, whereas you capped your upside to 7 or 8%. Who cares? I mean, it's your portfolio. It has to serve your needs, not other people's needs. And if your need is that downside protection is way, way, way more important for you than making 15% next year by June 2024, which is not even, it's almost 11 months, then this may be something that you may want to look at. Okay. All right. The ETF is for the 2 years. So that goes until 2025, right? So that's June 2025. Cool. Liked it, useful. I know today we went into really details and I really love that. This is how the real option stuff is supposed to be. Than just buying some stupid calls. All right, any questions? Oops. Either everyone understood everything or there is nothing. You didn't understand anything. Give me some feedback, guys. Okay, I see a comment. In my 20 plus years option trade, I never bought put for call or put or call for protection. Yeah, learn to manage. Yeah. Yeah, buying again, you've heard me said ad nauseum, buying options is not a winning strategy. It's the easy stuff, but not workable in long term. All right. Now this is our first 2D for me without TOS account. I mean, any doing a Robinhood probably not impossible, but I guess any decent account you could, at the end of a day, I mean, it's just buying a put and selling a call against it. The first one, right? So I don't think it's complicated. Yeah, the second stuff which we added little more enhancement, that I can agree was a little more complicated, but probably doing the first one is like buying a collar trade. That should be okay. You could do it even on Fidelity account or any other trading account. Should be fine. Oh, seeing the graph below before trading. But now you know. All right. So continuing. Okay, last comment. One more comment. The selling call strike price should always be higher than the buying put strike price, correct? So if it is not higher, then you're putting money up front, right? If it is higher, then basically you are sponsoring that insurance premium by selling a call against it. Now, the reason right now it is working out is, and now again, this may not exist forever, right? But if you really look at it right now, the premium, there's a it's called there's a skew in the premium, right? So if you're going $5, or so let's say 445, right? 446. If you go $5 on the put side, it's at 21 cents, like 99, let's say 20 bucks. If you go $5 on the call side, you have what, 34 bucks. So there's a lot of skew towards the calls, and that is why today this strategy is able to work, wherein you can buy the protection and also have a protection at a no cost, and also can enjoy some upside gains. If there is no skew, then both the calls and the puts are at the same pricing. Then if you try to do it at zero cost, you have a zero upside. But today the situation is there's a lot of skew on the call side. So calls are more expensive. So you can go further out in the call, and that's what you say is your upside. You define that upside. You can.
So normally the extrinsic value on the left and right side should be the same. So if you pick any strike like 445, you have your column extrinsic says $21 on the put side, and go over to the other side. That's your huge skew.
Yeah.
So have you tracked like how long this has been happening? Is it because of bullishness in the market?
No,
or?
no, I don't know. Only thing is when I was listening to this podcast, and I'm like, how come we are able to enjoy like 8% again? How is the skew that much? And that's what I came back and looked at it. I'm like, oh, it is actually right now the skew is more than what I generally see. So thought I'll share with you, but I have not done any. I've not been trying. I mean, this was not my original idea. It's just when I heard about a podcast, I'm like, let me go and see if I can do it myself. And that's where I started looking at it yesterday. I thought I'll share it today.
Thank you.
All right. Friday say you should make TOS account because Charles Schwab will be more strict with options accounts. TOS will be on Charles Schwab's. Yeah. You mean Charles account, Schwab account can't use TOS eventually? Oh, I think, anyway, I mean, if they take away my TOS, I'm going to move to some other account. I mean, I can't live without TOS, especially when it comes to options. So Schwab is gonna, I don't think they're good. They're probably gonna keep TOS and maybe sunset whatever their current system is. Otherwise, they're going to lose a lot of option traders. Okay, next one. Oh gosh, we're already 11:45. We have to hurry up. There's a lot of earnings we have to go through. So again, this is in spirit of transparency. I just want to be sure I'm come and share every month what I hold in my portfolio. Top 15, nothing has changed except that NVIDIA has gone out. End of June, I had NVIDIA, and you know why? Because I sold half of my NVIDIA position. So it's no longer in top 15. And we started building ACHD. As I come and share every week in terms of what I bought in long starts, ACHD is in, NVIDIA is out, right? Nothing else have changed. End of July, cash was still the highest. To me, I think the market is too high, but who knows? So having a good cash position helped me to take opportunities as and when they would arrive. All right, any questions before we jump into earnings, I guess? All right, I'll sip some water. All right. Moving on, what I bought and sold this week, TLT, PayPal, and INDA. So PayPal was down. And again, little bit I nibbled on it. I still hold PayPal in my position. To me, right now, it's too attractive. Only thing is they need to clean up their act and get a CEO, new CEO. The current CEOs already seem to be checked out. But this is, I understand the risk in here, so don't just follow me. It could stay volatile and low for longer than you may want to, but I have a patience on that. About TLT and INDA, which is India-based ETF, sold nothing, no long shares this week. All right, let's jump into earnings. Before earnings, anyone else have anything, any other questions? We'll have to do some rapid fire earnings. Why did you buy TLT? Again, I've been stacking up slowly, buying TLT, building positions on TLT, because eventually when the Fed will stop raising the rates, and maybe next year when they start to reduce the rates, then the TLT should go up. Okay. Now, that's the reason. Right now, the TLT has been going down. And I started building positions when it was like 97, 98-ish kind of a time frame. Then it's again, it was down to 96 or something. I think I picked up somewhere in 98 and some 96. Overall, if you look over years on TLT, I had traded a lot on TLTs because I've been doing a lot of options on TLTs over past 6-7 years. Generally, it would trade around 140s, right? 140s, 150s. But since Fed has started to cut the interest rates, had started to increase the interest rates since 2022, which was here, you know, TLT just started to lose ground. So then I realized maybe around 90s, below 90s, I'll start, I mean, when we started to get some visibility into Fed's plan, say probably they'll stop raising interest rates by the end of a year and maybe reverse the interest rates. So then these long-term bonds should TLT, you know, the interest rates, the yield and the price of the bonds move inversely, right? So then it should come back. So that's the reason. Cool. All right, and this is the options are used. It is very, you know, active in options. Volume is 42 million. If you look at options, they are 11,000. So it's pretty optionable. And I've used this ticker for many years. All right, let's move on to earnings. Okay, let's go through. I need to warm myself up. There's a lot of earnings that we need to go through it. So Probably will finish by 12:30. Okay, and I know where is Anirudh? Anirudh, yeah, you and I, we can chat it afterwards. Hope that time works. All right. I see another question. So you only buy SLT options or TLT, not the ticker? No. So when I say these buys are long share buys. Well, option probably I've done this week. Maybe I've done around 25 to 30 option trades. But what I come and buy and share, what I come and share here is the portfolio. This is my long options, not long options. It's called long stock portfolio. So this is only the long stock position which I add or which I sell. Like I closed MELI, Iron Condor, Amazon, Google, Airbnb. A lot of option trades I closed this week because Vol just got crushed. All right, starting with Uber. Gross booking 16% year over year. That's a good stuff. Then I can go into the details later on. Trips, 25 million trips per day on an average. Right? I like that. Revenue grew 14%. It is fine. Income from operations grew 326 million, up $1 billion year on year. Right? So that means last year they were down maybe around 700 or 675 negative, but this time the income of operations is positive, and which is a good metric to look at. The other is people also look at net income, right? Hey, is this company profitable or not? So in this case, the net income was 394 million, but I'm saying this is not a useful metric. You could ignore it for Uber, and I'll give you the reasons why I would. Adjusted EBITDA 916 million, which is up from 552 million. Net cash from operating was 1.2 billion. Free cash flow is 1.1 billion. So they are free cash flow positive. Looking and they have a 5.5 billion cash, so solid cash on balance sheet. I don't think anything concerning right here. When I'm looking at the margins, the story is a little different. Right? Gross margin is 40%. Operating margin is only 3%. Well, that's fine. This company is currently still growing and try to get free cash flow and focused only on adjusted EBITDA, not really net profit margins. So not surprised to see this. Some of the business updates, Uber One. They launched Uber One in additional countries. Now they are available in 15 countries. Interesting to see here. New product adoption driving overall growth in mobility engagement. So if you recall, Uber has got 3 businesses. Those who are new, I'll repeat it. Long time ago, we did a big deep dive into whole Uber, right? All the business of Uber and why I got bullish on Uber, like $20 share or something like that. One is their mobility, which that's what it's most known for. During the COVID, it also got known for the Uber Eats, which is delivering food, and then the freight business. These are the 3 businesses of Uber. So mobility means ferrying people or goods is a motto. I didn't know. I mean, is it in the US? But what they found is riders who took at least one motor trip, a bike trip, in a given month had almost 2 times greater engagement than average. This is cool, right? So average is almost 5.4. And they had 9.6. Strong progress on groceries and new vertical product experience contributing to delivery growth. So getting big on groceries. Now, this is what the CEO, Dara Khosrowshahi, has been very bullish on, is showing operating profitability, right? And I think during the earnings call, he made a comment. Street never expected us to do it, but I've been telling that we will achieve operating profitability by end of 2023. Now they basically did it sooner. So eventually now they're operating profitability. And this is what I want to focus on, not really on net profit. And I'll give you the reason why. So happy to see that they have been able to achieve finally the operating profitability. But if you want to take the other side, a big skeptic, you can say, their accumulated losses in Uber have been almost $30 billion over these years. But I would say that's water under the bridge already, right? Now they started to improve their business. Now they started to get this operating profitability, and they are the biggest, the baddest and the biggest dog in this business, right? Lyft is nowhere there. So I'm still bullish on it. Now looking at the segments, mobility is up 28%, and then the revenue is up 40%, and their take rate is up almost 30% take rate, which is great. Take rate means if overall, when you hail a Uber, you pay $100, Uber actually get $29.3 out of it in this quarter, right? Which this is like App Store kind of a take rate. Right? App Store take rate is what, 30%? Uber is now reached to a level of, in this quarter, 29.3% of a take rate. And I like that. Delivery side, situation is not that great. Not as good as mobility, right? Bookings up 14% to $15 billion. Revenue take rate is 19.6%, almost, I mean, a little bit higher than what it was last year. EBITDA is 21%. Look at the freight side. Freight revenue has been coming down. It's down 30% year over year. And of course, adjusted EBITDA is also not that great. It's down 1.1% from a year. And no wonder that now Uber, and this is not this news, but this is a news we saw 2 months ago, or maybe I didn't bring it in, but this is something which I noticed 2 months, 3 months ago, that Uber may be considering spinning off their freight logistics division to put more focus towards ride service and food delivery. Right? So doing a freight business is really tough. And Uber got into this business it's not too distant in history, maybe a few years ago, to capture the freight market, but looks like freight is not an easy business to deal with. Amazon has been the one who has been able to do it successfully. I think all other companies trying to build a freight business, and we'll talk about another company which reported results, and they're also selling off, the freight stuff. Unless you are big, maybe the market has become so competitive that there are individual companies which are focused only on freight, that companies like Uber and the other companies that I'm going to talk about are not able to compete against them. So it looks like that shows up in the numbers, and maybe Uber will spin it as a separate IPO or maybe sell off. We'll see in later quarters. Management commentary: robust demand, new growth initiatives like groceries, continued cost discipline resulted in excellent quarter, said Dara Khosrow-Shahi. I'm becoming a bigger fan of Dara, especially also, again, I heard about it in one podcast. There was almost 2-hour long interview or discussion with Dara. That was amazing, and after that, I became a little more bullish on Uber. All right, P&L statement, if I look at, and this is where I'll tell you why we should not focus on this net income, which was what they said, 394 million net income, net profit. That's a useless one for Uber, and here's why it is. So looking at the P&L statement, okay, great job done in reducing the general and admin G&A expenses, right? This is what Dara says, we are focused on cost cutting, and now it shows up. Otherwise, everything else is okay. Operations and support, not too big of a difference. Research and development, yeah, not too much of increase in cost. G&A expenses brought down. Other income, right? So this is where you get in your income from operations, is what I want to focus on, which is 326 million. Now, when you go further down the P&L, you see this other income, which is almost $2 billion difference between what it was last year. It was negative 1.7 billion. This year, it is positive 273 million, which is what, $2 billion difference. And that has jacked up the overall net profit to 394 million. But I would not pay attention to 394 because the most of the 394 is driven by this. This other income is based on what's happening in the stock market. It really doesn't concern how Uber or Dara or his team is executing the Uber's business. This net income is because of an accounting rule in which you have to mark your investments to the market, right? And this year, these shares probably have been going up, right? The market has been up, so their stock investments or the equity investment in Joby, Aurora, Grab, Didi probably have done good as compared to last year, right? Last year was tough for all these non-profitable companies, and they ended up taking $1.7 billion hit. And that's what, again, I'm like, I probably would have said the same thing. Don't pay too much attention on that $1.7 billion hit, because that's has nothing to do with how Uber is executing its business. Now, don't become overjoyed on the, getting $2 billion of increase in the value, because this has nothing to do with Uber's business, right? How the team is executing. What I like is liquidity position of 5.5 billion, but this equity stake is what's causing that other income to be so high. That's why we should ignore it. Right. What else? Looking at the cash flow, one thing which I want to look at is how much is the stock-based compensation. Didn't increase much. So they're becoming more disciplined in their stock-based compensation, at least as I would say this not too much of a dilution, right? So guidance side, gross bookings of $34 to $35 billion, adjusted EBITDA of $975 to $1 billion. So overall, I think I'm pretty happy with how Uber had executed. I'm happy that the shares have come down because I had a covered call at 42.5, which I rolled out. And then I sold a put against it. Hopefully, I'll be able to close the option trade for profit and still retain all my shares. So that's Uber. Let me look at the questions. Bobby says, why INDA ETF? Do you think there will be higher growth in the Indian economy in the long term? Yes, I am bullish on Indian economy in the long term. And long term means at least 5 years. You may not see it in next year or two, but I am bullish on the long-term side. In 30% cuts, how much they share with Apple and Google via app fees? I think everything will get reflected in their P&L statement. So I don't know Apple's is like what, 30%? So maybe 30% of 30%. But come what may, everything is reflected will be reflected in this, right? So their cost of revenue, depreciation, so this will be a cost of revenue will be what? So they made 9.2 billion, and then the cost of revenue is 5.5 billion. So that will include everything. Oh, Asif says some app categories are exempt. Oh, okay. Oh, they don't get cut off money, or for Uber X. That's fair. But in any case, everything is accounted for in their P&L statement. All right. Let's move on to the next one. MercadoLibre. Those who are new, MercadoLibre is not a name that's mostly talked about in the financial media, except yesterday when they actually got the CEO Marcos onto CNBC. I'm like, why are you doing this? Why are you doing this? And I'll be a little scared if Jim Cramer starts to talk about MercadoLibre, right? But in any case, jokes apart, yeah, this is not a company which is well known, but this is you could call it as Amazon plus eBay plus PayPal of South America. We've been talking about MercadoLibre ever since we started these 3 years ago. Every quarter we talk about it. And I mean, there's nothing that I don't like. So overall, if you look at it, net revenues were up 57.2%. Income from operations were up 16.3%. Total payment volume up 97%. Right? GMV is up 47.2%. So I don't know. I mean, it continues to execute. So GMV up 47%, up to $10.5 billion. Total number of, and this is coming from their e-commerce. Total number of items sold is up 18%. This is the managed networks, means on their own, 93.9%. Net revenue is up 57%. Total payment volume, which is on their payment network Mercado Pago, is up 97%. And it's not that this quarter is 97%. It's like their payment volumes have been through roof quarter after quarter. Total payment volume off marketplace, means not on MercadoLibre properties. Imagine Amazon Pay on, let's say, where you're going to Safeway, right? We don't have that here, but Mercado Pago is accepted, just like PayPal. It's being accepted at many places as a normal payment mechanism. That's up 130%. Credit portfolio, wherein they give loan to the smaller businesses, is up 21%. Last quarter, we had some concerns around their credit portfolio because they had to increase the provision for maybe losses. But this quarter, they have done a better job from a credit side. So I don't have any concern this year. Key highlights: another strong performance, record for quarterly income from operations with a margin of 16.3%. Brazil and Mexico were the fastest growing profit growth. So these two countries were fastest. And GMV surpassed $10 billion for the first time in the history of the company. Right? So they are continue to just perform, I would say. Again, MercadoLibre has a business, I would say 4 businesses. And in this quarter, I think I heard about a 5th one. So again, we can talk more about, are they extending themselves too thin? But their 4 main businesses are online, e-commerce, payments platform, credit, and the logistics, right? So we talked about their online e-commerce. Now we're looking at they're investing in logistics. Total payment volume, we talked about it. Credit portfolio grew 7% quarter over quarter. What else? Anything? What else I want to share? Total unique buyers is continue to go high from 40.8 million to 47.6 million. And each buyer on an average buys 6 items. From the fintech side, which is their payments side of the house, total payment numbers is up 69%. Total payment volume across both. So they have something called digital and acquiring TPV. What was the difference between these two? Hold on. Sorry, I had noted it down. Looks like I forgot about what's the difference between the digital and the other one. Let me just bring that up. Let's see. MercadoLibre. Let's bring that out. I think I noted somewhere here. Yeah, acquiring TPV is their on-platform online payments, point of sales, QR payments. Digital is their wallets, P2P transfer between Mercado Pago and the credit card transactions. Okay. So yeah, if you look, I mean, this is what we meant remaining what since 2020 I started talking about in this session. So now it's almost 3 years, right? Been tracking Mercado. Yeah, so but pretty happy with their overall payment business, I guess. And what I love the most about this company is how easy they make it for investors to follow the metrics, right? All the matrices. One company which I hate is Apple. They just don't provide any information. They're like, I don't care about you as a retail investor, but at least Mercado, and they do a very good job. And I was looking at this, I don't see anything which is a concern to me. And market also liked it, and no wonder it was up 11 or 12 or 13% after earnings. So they just continue to execute. I mean, I have no complaints about it. And if you really look at it, it is still sub $100 billion company. What is it right now? Only $66 billion. Right? So $12 billion of sales. So is it cheap when you're looking at PE? No, but I don't think we should even look at PE or forward PE, because the company is continuously investing back into building the businesses. So earnings is not a real metric that we should look at. So if you look at from PE perspective, you could say, oh my gosh, it's 86 and it's 50, but this company is currently not even focused on earnings. They're focused on growing the business. So I won't look at, in that case, maybe I'll look at price to sales, right? Is the business reflected in the sales that they're doing? I mean, from that perspective, 5-6 is not that super expensive. Okay. So that's MercadoLibre. I mean, just plain old simple way of doing business and executing it. Any questions before we move on to the next one? All right, Shopify. So Shopify, they talked about a lot of their new products. Now we don't have much time to go through each one of them, so I'll skip that. I'll jump on to their numbers. But only one thing which I want you to look at is AI. They talked a lot about AI, how they're integrating their Shopify Magic and Shopify Sidekick across all their products to make it easier for merchants to do the customer service. Now you can look into the details of, there are some other products that they rolled out. 3 products I'll talk about is Shop Pay installments, right? BNPL. That rings a bell. Everyone is into that. So now they also integrated their pay installments. Complete the US rollout of Shop Cash, right? And bill pay. So now Shopify, and this is a theme that we are seeing everywhere. This starts with building or helping e-commerce moving into the payment stuff, right? So Shopify has got what, 3 new, they launched 3 new products, all have to do with payments, right? Shop Pay installments, Shop Cash, Shopify bill pay. So again, moving more into the payment side. They also completed the sale of Shopify logistics business, right? That's why, remember I told you earlier, logistics is difficult, looks like. If you're not doing only logistics, or if you don't have as deep pockets as Amazon has, because they have AWS, it's tough business to manage. So Shopify, they bought this business recently. It's called Deliver, Deliverr, and they ended up selling that. I mean, they announced the sale a while ago, I think last quarter, and now they've kind of completed the sale. So looking at the numbers, they beat on GMV, increased 17% to 55 billion, beat on total revenue, beat on adjusted EPS, right? Now, when talk about revenue, Shopify has got 2 distinct revenue streams. One is merchant solutions. The other one is subscription revenue. Both of them have increased. Gross payments volume also grew to 31.7 billion. Other thing is on the subscription side, gross margins on subscriptions in Q2 of 2022, it was 76, almost 77%. Now it is 81%. And this came in because Shopify also increased their subscription prices. There was some concern that, some merchants probably may leave the platform. Looks like didn't. They continue to enjoy higher margins. And the revenue also increased 21%, and the margins also increased. So I guess maybe they have some pricing power. Okay. Monthly recurring revenue increased 30% to $139 million. Gross profit grew 27% to $835 million. Gross margin was down from $50.7 million to $49.3 because the merchant solutions has much bigger, it grew much bigger, and this is lower margin, high volume business. And subscription is higher margin, but since this one grew much faster than the subscription one, they took a little bit hit on margin, but not much concern. Operating loss was $1.6 billion, but we'll talk about it, why I'm not concerned about this one, right? Because a lot of that loss is coming, and let's jump onto the P&L statement. A lot of big portion of that loss is coming because of a one-time charge of selling the Deliver business to Flexport. So this is not going to happen next year, right? So this is a concern in this quarter, but this is just a one-time charge. So not concerned about it, right? You do the M&A, you sell it off, you probably have to pay, you have to let go people, and then you have to pay severance. All that is one-time cost. So if this was not the case, they would have been, even after taking this, how much? They made what, operating, 1.6. They would have been up at least $100 million if this wasn't the case, positive $100 million. Okay, adjusted operating income, $1.146 million. That's what I was talking about, right? If you don't account for this 1.7, then 146 is what they would have went for. Free cash flow is $97 million. Cash and marketable securities on their balance sheet is almost $5 billion. Pretty happy with that. This doesn't tell us the story. Obviously, because of the one-time sale, their operating margins were like down 100% because of the one-time charge. And then same is the case with profit margin. So for this quarter, I don't want to look at operating margin and profit margin. Talked about P&L statement. Again, this one, on one hand, they had a impairment that they had to take on operating expenses. And then they also had a $335 of this other income. So both of these elements make this whole net income or net loss completely useless metrics to look at for this quarter. It's the only thing we should want to focus on is an operating income or I would say operating margin or gross profit margin. Right? There's so much of the other stuff. And this is again because of Shopify has got some investments. Revenue to grow at low 20s or year-over-year basis, market did not like it. So even though, after the earnings, stock went higher, then they came and told that we're going to grow at low 20s. And the gross margin will be only 2 to 3% point higher. Street was expecting more. And then I think the shares were punished the next days. Right? Third is they said operating expense dollars will be flat to up slightly. And And market was then like it. The market was expecting better margins, but they want to continue invest. Stock-based compensation 110 million, not a big deal. I think that's fine. Yeah, so overall, not big concern on Shopify. Let me read some comments. Why can't Amazon or other companies compete in that market? First mover advantage may be, oh, Amazon is there. It's not that Amazon is not there in South America, but they have not been able to compete against MELI. So Amazon has been there. The other hope SC is the next MELI. Other thing is even SC had gone into the South America, and because I hold both the shares, I also heard SC management team talking about the fact that they do want to reduce their investments or keep their focus on their Southeast Asian market than the other markets like South America market, because they are finding it is difficult to compete against the incumbents in the South America market. So I'm like, yeah, good. It means MELI is doing a great job. And for me, like, yeah, focus on the Southeast Asian market. SC, I hold your share, so you better do a good job over there. So maybe, I mean, it's that they've been pretty strong. Amazon is there. It's already there in that market, but MELI continues to execute well despite that fact. Now here's a little fun. I mean, I saw on Twitter, after these results of total payment volumes and all that, someone quipped on Twitter saying, either MELI is like a superstar or they are laundering money for the drug lords. I don't know which one is true. Either they are super exceptional because they've been executing, or probably they're laundering money for the drug lords because the stats that they see are amazing. Okay, I don't have any information with respect to that. So I have to only go with what the financial results tell us, right? Everything else is a speculation. All right, let's talk about PayPal. While MELI did good, PayPal not that great. Total payment volume was up 12%, but of course it's already at a very big, from a very big base. Venmo grew only 8%. I was a little surprised. I thought Venmo was a growth engine, but that's even growing at slower pace than the normal PayPal. The worrisome is this active accounts, right? It grew only 0.5%. So new active accounts, and this is a sequentially decline, as compared to Q1. So and I think that's what market didn't like it, that we are not really growing the number of accounts. And it's kind of a quarter by quarter, the growth is slowing down. Transactions per active accounts is up 12%. Revenue is up only 7%. So PayPal doesn't seem to be the growth story that it used to be earlier. Non-GAAP EPS is 1.16. So its adjusted operating margin rose from 19.1% a year ago to 21.4%, but it was down sequentially. So which is, again, market has a concern on, hey, quarter over quarter, you are moving in the wrong direction. Right? So no wonder they, punish the stock. But they also do a buyback, $1.7 billion worth of stock, which is almost 7%. And they're trading at 12 times forward earnings, which is, I guess, right now, compared to the other tech firms, it's cheap. Guidance was mixed. Third quarter, they are forecasting a revenue of 7.4 billion, again, 7-8%, right? Which will be a non-GAAP EPS around 14% increase. So that is, it's no longer a big growth company that it used to be. And right now, the biggest challenge is they have to find a new CEO. And we didn't see any update from the company on where they are, how close they are to get a new CEO. So I would rather wait and watch for the new CEO for any big changes in the company. Otherwise, it's kind of just chugging along at a 7-8% growth rate, right? Not too much. Valuation perspective, it looks very attractive, given the fact that just a buyback, it's almost 7% reduction in the share count. That's attractive. And current valuation, if you run your, let's say price to earnings or DCF model, it's attractive, but it's valued low because, hey, there's not much growth priced into it. So that's PayPal. Okay, let's move on. Square or Block, formerly known as Square. Again, overall, second quarter, they had a gross profit of $1.87 billion, which is up 27% year over year. That's cool. And to strong momentum with its banking product, we generate $167 million in gross profit, driven primarily by loans, transfer, and the debit card. Again, Square has got two businesses. One is on the merchant side. I would say Block has got multiple businesses. One is the Square, which is the merchant side. One is Cash App, which is on the consumer side. And the third one, which is Blocks, is their Bitcoin and all other stuff business, right? So they do talk about these three things. Now, overall, let me just look at, they raised the EBITDA for their full year. Margins are under pressure, and that's why they want us to focus on adjusted operating income, right? I'm not sure if I'll, go with them, but if you get into the details of this, they had a bigger revenue coming from Bitcoin this year, but overall, I still don't like their overall operating income. If you look at it, it's negative $132 million. So that's what they say, hey, look at my adjusted operating income, which is positive $25 million. So little pressure on the margin. But I guess we still have to give them some time. So, and who knows, maybe next quarter, Bitcoin halving is coming up, not next quarter, in April 2024. And if some of those court, one is the court results on some of those lawsuits against these crypto companies, and the ETF, if we see anything positives out of it, and we see Bitcoin getting traction or crypto getting traction, then this has got some tailwinds behind it. All right, moving around to the biggest one, which is Amazon. Net sales increased 11%, $134 billion. And we just talked about a quarter, right? So sometimes when you move from companies like Squares and the MELIs of the world to Amazons and the Apples, then, the whole scale is different, right? So MELI, like $3.4 billion of a revenue, and Amazon is like, come on, I made $134 billion, right? And both are talking about the same quarter, completely different scale. All right, what I want to focus on over here. So we'll look at, I don't think there's, every other metric was just positive. North America sales up 11%, international up 10%. AWS, which is what we generally want to focus on, is up 12%. Remember, their competitors, Google as well as Microsoft, are in 20s. And if I recall, Microsoft was what, 26%? Google was what, 28? Something like that. I forgot when we discussed the result. But they are in, I would say, mid-20s. Sending a message. Okay. They are in mid-20s, and AWS is 12%. But they're coming up from much bigger base. Online store up 4%, physical store up 6%, third-party sellers 18%, subscription at 18%. The thing that I want to focus on and talk about is advertising. Remember? And I talk about advertising. It's Amazon. What's advertising has to do with Amazon? Yeah. So that's what I would say, if you don't get into the details, you'll miss out. But what we've been talking about this advertising for 4 quarters now, and go back and maybe if you review those, I said, watch out for advertising. This could be the next growth engine for Amazon, and it's a perfect strategy for them. And looks like they continues to execute it. They never used to report advertising as a separate segment a year ago. Maybe I have a slide or two for that. Yeah, I think I do. But once we talked about it maybe 3 quarters ago, I'm like, watch out for this one. So happy to see advertising is up 22%. Right? I'll not bore with any of these numbers. You can go and look at these numbers for yourself. What I do want to talk about is everything was all beat. Right? They were all up as compared to the year-on-year, plus it was also beating all the expectations from the street. So no wonder the stock was handsomely rewarded. Right? Coming back to advertising, it's been a sleeping giant. And if you look at advertising revenue, it's been growing up. Last year it was $7 billion, is now up almost 7.8 to $10.7 billion. Right? Let's continue to execute. And like I said, it wasn't even a thing 2 years ago. I went back and looked at that 2 years ago. There's no advertising in here. You see? So we thought everything got clubbed under something called others. Right? And Q1 2020, till Q1 2021, there was no advertising separately. But if you've been watching the business of Amazon or seeing what Jesse and before that Jeff Bezos has to say, you would have realized that, hey, this is a business that is growing. It's just like services business of Apple. Apple didn't used to break out their services revenue, I think, prior to 2019. But then we talked about it saying, watch out for services. That's going to be next growth engine. And this is what saved Apple for this quarter is services. Nothing else is working. When I say nothing else is working, from a revenue perspective, it was services was the silver lining. So I would say the advertising for Amazon is what YouTube is for Google. Right? Again, no one pays attention to some of the smaller businesses, which could become next growth engine for these bigger companies. Right? So balance sheet, pristine balance sheet, I would say if you just look at cash and cash equivalents and marketable securities, almost $65 billion, pretty nice for Amazon. So yeah, I have no concerns on Amazon. I mean, of course, we'll continue to sell options and reduce the cost basis. So I had a little, not concern, but no, that wasn't Amazon. Yeah, Amazon, I mean, I had a triangle on Amazon, 120 and 150. So pretty, after the earnings got auto closed at profit target. So reduce the cost basis. I think now I have an iron condor on it. Or maybe put spread and a covered call at 160 or something. I see another comment. What's your opinion about TTD? So before I jump into Apple, let me respond to that. If I look at Roku, Google, Netflix, all the companies have done, and now, well, look at Amazon. All the companies have done better in terms of advertising. So if I had to take any cue from that, the cue is that the advertising has, as compared to the last year, the ad business is the companies that reported better in terms of ad businesses, right? So looking into that cue, I'm assuming that the trade desk would report a good results. Now, what could happen to stock? That I don't know. I can talk about the business. I'm expecting trade desk to report better because they are one of the biggest player in the ad tech space. Now, how much of that got already priced in? Only God knows. But I'm expecting, unless they goofed up something, if they report bad results, I'll have to do a magnifying glass and say, what the heck you did? Every other company is reporting better results from advertising. Anyway, coming to Apple, first is it is Q3 for them. So it's not Q2, weird Apple cycle. Revenue is down 1.4%. So it's not up. Revenue is down. And this is, I think, second or third quarter where they'll be having down revenue. Overall product at 60.6 billion. Services is up 8.2 billion, 8.2% year over year. And this is a new all-time record for services. They have a 1 billion paid subscriptions. A billion paid subscriptions. And management expect further acceleration in services in Q4. So only silver lining for now, it is their services. The products, the product revenue probably not worked out, right? EPS was better than expected. They got a $26 billion operating cash flow. They returned $24 billion to shareholders. Right? And paying a cash dividend on August 17th. If you hold Apple shares, hold on till August 14th if you want to capture the dividend. Right? Okay, margins 44. I'll skip that. Sales by category. Right? If you look at it, iPhone really didn't work that great. Hold on. They have a reverse one, I guess. Yeah, 81.8, right? So this one, the first one is 2023. I'm like, iPhone increased? That's not the case. So iPhone was down from 40.6 to 39.6. Mac was down. iPad was down. Only the category that worked when it comes to the products was wearable, but not enough to compensate for the other product declines. Services was the one which kind of helped them, but overall it was still down 1.4%. Okay. Oh, they are strong in emerging markets. So lower cost phones. So no wonder they're setting up a phone factory in India. Americas is down 5.6%. Europe and China, it was up, 7.9 to 4.8%. But overall, iPhone was down 2.4%. Japan, they were down 11%. Asia Pac, they were down 8.5%. So overall, if you just look at it, like, come on, Apple is not even executing, like from a product perspective. So revenue has been going down, and only services isn't working. But the balance sheet, they got enough of cash on their balance sheet. But when you're looking at Apple, you should look at overall shareholder returns, right? Business side, revenue is not that great. I understand, I get it. But what else they are doing? They're also buying back shares. They're also paying dividend. They're also retiring their debt. So as a shareholder, you should account for all these things and then say whether you want to still hold Apple or you want to not hold Apple. And looking at the overall, their total current asset and the marketable securities, this is like 226 billion. And just for a fun sake, I was looking at S&P 500 market cap. Just their cash and the securities would be ranked 40th if this was just a separate company. So it's a big behemoth. It got so much of cash available on their balance sheet, $122 billion. They can happily invest. They can continue to pay dividend, do share buyback, right? Guidance was not that great. It indicated that the overall for full year, the overall revenue will be less than the last year. Right? So market was looking for growth. Market got declined. Stock was down 5%. And this was their third consecutive quarter of revenue declines. So if I'm looking at these numbers, it was negative 5.48 in end of December. End of March, negative 2.51, and now you got negative 1.40. Last time when this happened, 3 quarters of successive consecutive revenue decline was in 2016. I had to go back 7 years when it declined 3 consecutive times, negative 13, almost 9%. But the stock is up 500% since then. So I am not counting out Apple and saying, hey, you got like revenue decline happening continuously. They got such a captive audience and a rich captive audience that they could continue to sell more and more stuff to them, right? So I'll watch out. I'll still hold Apple. As you guys have seen, Apple is probably the top after SPY. That's my second biggest individual stock position. Vision Pro, who knows what else they may come up in the subscription. Again, history may not repeat itself, but I don't want to count out the company that's holding $122 billion on their balance sheet. If nothing else, I mean, over the last 7 years, since 2016, they have bought back 30% of their shares. They'll just buy back shares, if nothing else. All right, that was the last one. We'll skip the news charts. I think we are way over our time. And I appreciate you guys still hanging around. So thank you very much. We'll finish some questions. Now I should see some offers on my iPhone upgrades. Let's see how desperate they are. Considering global smartphone market is down, Apple rev down by 1 day of sales doesn't seem bad. Yeah, that's true. Yeah, I didn't know what overall global market, but that's a good report. Thank you for sharing that. Eyes on September after iPhone 15 shows up. We'll see how the iPhone sales shows up. But I think market is already accounted for that the iPhones is not the similar growth engine at what it used to be. And Apple had been giving that signal for last many quarters, saying focus on services. I mean, since, if my memory goes right, it's only in 2019 they started to break up services revenue, saying now I think it has become substantial that we want Street to focus on services. All right, that's the end. If you have any other questions, maybe I'll hang up for 2 minutes. If you have a JS, if you have a minute, I have a QQQ trade similar to SPY. Yeah, throw in here.
Yeah, I put it there. It's a QQQ similar. If you can put that in and also add 100 shares of Qs. I'm curious how much portfolio margin this would allocate.
Okay, so let's trade this. So what do you got? You're selling.
Yeah, it's gonna make a similar Iron Condor style P&L graph. And if you analyze that and also add 100 shares on top of it.
You're buying a put and you're okay, so and then you're selling.
It's gonna be like the SPY one.
Call spread.
You gotta add 100 shares to make it flat.
So let's add 100 shares. Add the money.
100 shares of Qs.
Oh, sorry. Oh, 100 shares of, or just plain 100 shares, right? So let's. Oh, that may or.
Go to underlying. You gotta open the underlying little tab there.
What's happening? What am I missing here?
Here, you can just copy mine if that's easier.
You're on the trade page.
Yeah, I'm on trade page.
Go to analyze.
Open the underlying is you gotta open that little triangle on the under.
Oh, there we go. I'm like, where's that?
It was hidden.
Disappeared. Yeah. I'm like, what the hell? So 100 shares, right?
Yep. There you go. Now it's flat. So you see a similar thing. So how much total capital is this taking?
For me, it shows 35. So you got one extra call in here. So you got one naked call.
No, there's no naked. There's a call
Oh,
spread.
sorry, you have a
just like
call
I put
spread
on.
and you have 100 shares. Yeah. So yeah. So right now there is nothing. So you shouldn't be exposed.
Yeah, that's only at expiration, but it's
That's
very similar. So there's a skew in the Qs, just like in the SPY. That's why I did it on.
Sorry, what expiration was that?
Oh, the same June.
29
Oh no,
December.
December, but it's the same. All across the board, there's a skew, call skew.
How come? I mean, are you still expecting market to go high? So generally the skew is on the good
It's
side.
interesting. I don't know, because there's some substantial call skew.
Yeah, if I look at this, what you got, let's say 370, it's $16 and it's like $22. It's almost 25% higher extrinsic value on the call side. Well, market is like QQQ. Damn, this thing is already up 41% and still so much of a skew on the call side.
So yeah, it's interesting. I'll play some more with it, but there's got to be some hidden risk of assignment or something.
Yeah. Rest, maybe the market is offline. We can check this out in if it shows anything different.
It's not just that. It's it could be. Sometimes the market moves
the
a few
pricing
points
you may
and the
not
options.
the option pricing sometimes may not be updated.
True.
I have seen some weird pricing showing up. So yeah, we can check it tomorrow.
That's true. Yeah,
to
you're right.
What's the exact pricing that shows up. Yeah, but at least the trade that I was sharing for SPY, that was, I think I did it yesterday. So
in market hours.
No, that I don't recall. Maybe it was off market hours. So some of that may be off, but I guess the whole idea was the process behind it. So you could try to see what the pricing you get. All right. I guess that's it. Sorry, what? 12, almost 3 hours today. I really appreciate you guys being here. Looks like you guys have nothing else to do than to come and spend time here. No, I'm so thankful. So thanks being here. And I know I need to talk to someone. So, all right. So I will end this meeting right away. And Anirudh, you can jump back into this one.
Sure.
All right. Cool. All right, guys. We'll talk to you all next week.